The United States government is nearly $39 trillion in debt. That number went up by $7.23 billion just today, and yesterday, and the day before that. Every single day, the federal government borrows more than $7 billion to keep running. If you divided that debt equally among every American, every man, woman, and child would owe $113,000. Per household, that figure climbs to $288,000. That's not mortgage debt. That's not student loans. That's just your share of what the federal government owes. And what makes this moment different from any other time in American history is not just the size of the debt, it's the speed at which it's growing, the cost of servicing it, and the fact that almost nobody in Washington is seriously trying to stop it. Let's start with the trajectory, because the numbers tell a story most people don't fully appreciate. In 1980, the total national debt was about $900 billion. By 1990, it had tripled to over $3 trillion. By the year 2000, it was $5.6 trillion. Then the pace accelerated. By 2010, after the wars in Iraq and Afghanistan and the 2008 financial crisis, it had more than doubled to $13.5 trillion. By 2020, fueled by pandemic spending, it hit $27 trillion. And as of March 2026, it stands at $38.86 trillion, according to the Joint Economic Committee of the U.S. Senate. That means the national debt has increased by $10.86 trillion in just 5 years. That is more than the entire national debt was in 2008. Now here's the part that should concern every single taxpayer. The cost of carrying that debt is exploding. In fiscal year 2025, the federal government spent $970 billion just on interest payments, not paying down the debt, not building roads, not funding schools, just interest. That is nearly $1 trillion a year going to bondholders and creditors simply for the privilege of borrowing money. And it's about to get much worse. According to the Congressional Budget Office, net interest costs are projected to more than double, reaching $2.14 trillion by 2036. That's nearly double the entire defense budget. Interest on the debt is now the fastest growing line item in the entire federal budget. To put that in perspective, the average interest rate on total marketable national debt is currently 3.355%, according to Treasury data. 5 years ago, it was just 1.512%. That difference, applied to trillions of dollars, translates into hundreds of billions in additional annual costs. So where does the money come from? Who is actually lending the United States government all this money? The answer might surprise you. As of March 2025, debt held by the public totals roughly $29 trillion. Of that, about 68% is held by domestic investors. The Federal Reserve is the single largest holder, followed by investment funds like mutual funds and pension funds, then commercial banks, state and local governments, and insurance companies. Foreign investors hold the remaining 32%, or about $9.1 trillion. Japan is the largest foreign holder of U.S. debt, followed by the United Kingdom and then China. But here's an important shift. Foreign ownership has been declining. In 2011, foreign investors held 49% of debt held by the public. By 2025, that share had fallen to 32%. This means the U.S. is increasingly borrowing from itself, which sounds harmless until you realize what that actually means.
When the Federal Reserve buys government debt, it does so by essentially creating new money. This expands the money supply, which, over time, can fuel inflation. And when domestic pension funds and insurance companies are the primary buyers, it means that American retirement savings are increasingly tied to the government's ability to keep borrowing without consequences. If confidence in U.S. debt ever wavers, those savings could be at risk. Now, let's talk about why the debt keeps growing. Because it's not just one party or one president. This is a structural problem. The federal government consistently spends more than it collects in revenue. In fiscal year 2026, the Congressional Budget Office projects a deficit of $1.9 trillion. That's the gap between what the government takes in through taxes and what it spends. And that deficit is expected to average more than 6% of GDP for the next decade. The biggest drivers of federal spending are mandatory programs. Social Security, Medicare, and Medicaid now consume the majority of the federal budget. These programs are growing faster than the economy because the population is aging. In 1960, there were 5 workers for every retiree. Today, that ratio is closer to 3 to 1. By 2040, it could be 2 to 1. And here's the alarming part. The Social Security Trust Fund is projected to become insolvent by 2032, according to the latest Congressional Budget Office estimates. When that happens, benefits would automatically be cut by roughly 20 to 25% unless Congress acts. Medicare's Hospital Insurance Trust Fund faces insolvency around the same timeline. These are not distant hypothetical problems. They are less than a decade away. So what are the potential consequences of all this debt? The first and most immediate consequence is what economists call crowding out. When the government borrows heavily, it competes with the private sector for available capital. This can push up interest rates for businesses and consumers alike. Higher interest rates mean more expensive mortgages, car loans, and credit cards. It means startups have a harder time getting funding. It means economic growth slows because capital is being diverted from productive investment to government debt service. The second consequence is reduced fiscal flexibility. If a major crisis hits, whether it's a pandemic, a war, or a financial crash, the government's ability to respond is constrained by the debt it already carries. In 2008 and 2020, the government was able to spend trillions in emergency stimulus because interest rates were low and the debt was relatively more manageable. That option is narrowing rapidly. The third consequence is the risk to the dollar's reserve currency status. The U.S. dollar is the world's primary reserve currency, which gives America enormous advantages, including the ability to borrow cheaply and run persistent trade deficits. But that status depends on global confidence in U.S. fiscal responsibility. Countries like China and Russia have already been reducing their holdings of U.S. treasuries and exploring alternative reserve assets, including gold and digital currencies. Now, to be fair, there's an argument that debt doesn't matter the way people think it does. The United States borrows in its own currency. It has the world's largest economy. It has never defaulted on its obligations. And historically, periods of high government spending have been followed by strong economic growth.
That's all true, but there are limits. Japan's government debt exceeds 200% of GDP, and the country has experienced decades of stagnant growth and deflation. The U.S. debt to GDP ratio now stands at 125% according to CEIC data, and it's projected to reach 175% by 2056 according to the Bipartisan Policy Center. At some point, markets may begin pricing in that risk. The bottom line is this. The national debt is not just a number on a screen. It represents real obligations that will be paid by real people, either through higher taxes, reduced benefits, inflation, or some combination of all three. Every dollar spent on interest is a dollar not spent on infrastructure, education, healthcare, or defense. And every year that Congress delays meaningful fiscal reform, the eventual adjustment becomes harder and more painful. If you're watching this and wondering what it means for you personally, here's the practical reality. Your taxes are likely going up at some point, regardless of which party is in power. Social Security benefits, at least for younger workers, are likely to be reduced or delayed. Inflation will continue to erode purchasing power, making it harder to save and retire comfortably. And interest rates, while they may fluctuate, are unlikely to return to the near-zero levels that fueled the easy money era of the 2010s. The $39 trillion question is not whether the debt is a problem, it's how long America can keep kicking the can down the road before the road runs out.